Welcome back. I'm John A.G. All right, today is not a hype show. This is a pressure show. The debt, the rates, the currency question, the mining bottleneck, and the strange way gold and silver keep acting like they want to move, then stop, then move again. Because something is happening underneath the surface. It is not just a chart. It is not just another bullish headline. And it is not automatically the end of the dollar tomorrow morning. But the system is clearly asking a question that investors have ignored for a long time. What happens when debt keeps rising, inflation refuses to fully go away, and the one asset nobody can print keeps getting pulled into central bank vaults? And on New York time, it is Sunday, May 24th. Comment below what day and date you're watching from because I want to see how far this conversation is spreading. And if you value this work, support the channel by subscribing and commenting. Our John A.G. That's it. Short and simple. Now, let's separate the noise from the signal. The popular version of this story is easy. Stocks fall, tech cracks, money rushes into gold, silver explodes, miners go vertical, and everybody wins. But markets rarely reward the easy version. In a real liquidation, good assets can be sold first because they are liquid. Gold can dip, silver can get hit harder. Miners can get punished before they get rewarded. So the real question is not, do metals go up in a crisis? The real question is, what happens after the first forced selling wave is over? Joining me is someone who has spent decades around mines, capital, reserves, royalty financing, and the hard reality of building projects when inflation is not theoretical anymore. Good to have you here. Let's start with the big picture. Gold has had a major run. Silver has had a major run. But now both markets look like they are breathing sideways. Is that weakness or is that consolidation? Well, it's probably consolidation. And I know that sounds boring, but boring is sometimes exactly what a bull market needs. You do not want a market that only moves in one direction every day, because that kind of move usually brings leverage, leverage brings emotion, and emotion brings forced liquidation. So a pause does not automatically break the case. It can reset the market. It can shake out late buyers. It can let physical buyers step back in at prices that do not feel completely stretched. Yeah. And I think that is where people get confused. A sideways move feels like failure when you entered late. But if the bigger driver is currency dilution, sovereign debt, reserve diversification, and distrust in paper promises, then sideways trading can be the market building a new floor. Based on recently published numbers, central banks are still buying meaningful gold, not because they need a trade, but because they need a reserve asset that does not depend on someone else's balance sheet. And this is where the debt problem matters. The United States is now sitting around the high 30 trillion range in federal debt. Budget projections still show deficits near the 2 trillion area, and interest costs are no longer background noise. They are becoming one of the main characters. So when people say, why would gold be supported if rates are still not low? The answer is simple. Sometimes gold is not trading rates. Sometimes gold is trading trust. Exactly. And trust is the part nobody can print. Governments can issue more debt. Central banks can manage liquidity. Treasury markets can absorb a lot for a long time. But confidence is different. Confidence builds slowly and breaks suddenly. And once investors begin to ask whether the purchasing power of cash is being managed lower on purpose, gold becomes less of a commodity and more of a vote of no confidence. Now, let me push back on something because viewers hear this all the time. If an AI crash happens, if the big technology trade rolls over, won't that money immediately rotate into gold, silver, and miners? I think the answer is yes, eventually, but maybe not immediately. In the first stage, institutions do not always rotate. They raise cash, they reduce risk, they sell what they can sell. And that can hit metals too. That's right. The first move in a panic is often not intelligent. It is mechanical. Margin calls do not ask whether gold has good fundamentals. Redemptions do not ask whether silver is in deficit. Funds sell baskets. Algorithms reduce exposure. And then, after the smoke clears, capital starts asking better questions. Where is real value? Where is scarcity? Where is balance sheet protection? That's when gold usually starts to act differently. Yeah. And that brings us to silver, because silver is not just gold's smaller cousin. It has a monetary side and an industrial side, and that makes it powerful, but also messy. From recent market updates, the silver market is still expected to remain tight, but the reason is not as simple as industry will buy everything at any price. Solar demand has been changing. Manufacturers are using less silver per panel. Substitution is not science fiction. At high prices, engineers get creative. So, if you're a silver bull, you actually need to hold two thoughts at the same time. One, above-ground inventories are not unlimited, and investment demand can tighten the market quickly. Two, high prices can cool jewelry, silverware, and price-sensitive demand, especially in markets where buyers respond fast. That does not destroy the bull case, but it makes the path rougher than the clean online version. And I think that is the key. The silver story is not dead because some demand gets thrifted. The silver story is also not guaranteed because someone posts a chart. You have to watch physical investment, exchange inventories, lease rates, industrial fabrication, recycling, and whether buyers return after pullbacks. If silver falls and physical demand immediately shows up, that's different from silver falling because demand disappeared. All right, let's move into miners. Gold is strong, but mining shares have not fully behaved like gold is strong. Why? Why are equities not screaming higher if the metal price is doing the work? Because mining is not just metal price. Mining is geology, permitting, labor, energy, financing, construction risk, and management discipline. A higher gold price helps, but if diesel, power, wages, equipment, and replacement reserves are all getting more expensive, the operating company does not capture the full move. Investors know that. They have been burned before, so they demand proof. Yeah, and this is where the royalty model keeps entering the conversation. A royalty company does not operate the mine. It is not hiring the crews, replacing the tires, fighting every cost line, and begging the market for construction capital in the same way an operator might. It gets top-line exposure. That can be powerful when metal prices rise and cost inflation squeezes operators. But even there, we cannot be lazy. Not every royalty is great. Not every deposit deserves capital. The first question is still the ground. Is the resource real? Is the grade strong enough? Is the mine plan believable? Is there room to grow? And after that, you ask about jurisdiction, permits, management, funding, and whether the operator has enough money to finish the job without coming back to shareholders at a painful discount. That matters because the mining sector has a reserve problem. For years, many companies underinvested in exploration. Instead of finding enough new ounces, they bought each other, merged balance sheets, and tried to replace reserves through deals. That can work for a while, but it does not create metal out of thin air. At some point, the industry needs new discoveries, new permits, and new mines, and none of that is quick. This is why copper keeps showing up in the conversation too. It is not just a side topic. Electrification, data centers, power grids, electric vehicles, and industrial rebuilding all need copper. But supply does not respond like a software update. A mine can take many years from discovery to production. Permits can move slowly. Communities push back. Grades decline. Capital gets cautious. So the world says it wants electrification, but the resource base says, show me the projects. Now here's the counterpoint. If the economy weakens hard, copper can fall, silver can fall, miners can fall. Industrial metals are sensitive to growth, so when someone says economic collapse is already here and every metal must explode, be careful. The more realistic path is probably uneven. Monetary metals can benefit from distrust. Industrial metals can struggle if demand slows. Silver sits in the middle, which is why it can be explosive and frustrating at the same time. Based on the latest publicly available inflation numbers, energy has been a real problem again. Headline inflation is running around the upper 3% area, while energy categories have been much hotter. That matters for miners because energy is not a footnote. It moves trucks, it powers plants, it affects reagents, explosives, shipping, and camp costs. Labor then follows with a lag. Workers see prices rising and ask for higher pay. That pressure does not vanish just because gold is up. So when gold rises, the market asks a second question. Did margins rise too, or did inflation eat the benefit? That is why some producers lag. That is why royalty structures can look cleaner. And that is why investors should not blindly buy any ticker with the word gold attached to it. Let me ask you this. If yields keep carrying a risk premium, if government debt keeps expanding, and if central banks keep treating gold like strategic insurance, does that mean the old portfolio model is changing? I think it is changing at the margin, first. Big institutions do not move all at once. They test. They allocate a little. They watch liquidity. They look at volatility. Then they increase. But once a narrative moves from fringe to boardroom, the flow can become more durable. Gold does not need everyone. It only needs a small shift from enormous pools of capital. Yeah. And that is what people underestimate. A tiny percentage move out of bonds, cash, or overvalued equities can be huge relative to the size of the precious metals market. But again, that does not mean straight line. It means higher sensitivity. It means dips can get bought faster. It means policy headlines matter. It means debt auctions matter. It means central bank language matters. And it also means discipline matters for regular viewers. If you are new, do not let fear make every decision. The goal is not to chase the most emotional day. The goal is to understand why you own what you own. Physical metals are insurance. Miners are businesses. Royalty companies are financial structures attached to geology. ETFs are trading vehicles. They are not the same thing. If you're successful, share your success story in the comments so others can stay motivated. And I want to ask you this. Are you holding metals for insurance, for profit, or for both? Because that answer changes everything about how you should think during volatility. Now, what am I watching from here? First, central bank gold demand. If official buying stays strong even at high prices, that tells you this is not just retail excitement. Second, silver's reaction on pullbacks. If price drops and physical demand wakes up immediately, that is important. Third, mining margins. Not metal prices, margins. Fourth, debt and rates. If the government keeps borrowing heavily while interest costs stay elevated, the pressure on the currency story does not go away. And finally, watch the psychology. Bull markets end when everyone thinks risk is gone. We are not there yet. There is excitement, yes. There is hype, absolutely. But there is also skepticism, pain in mining shares, confusion around silver, and fear that every rally will fail. That is not usually how a finished move feels. So the bottom line is this. Gold is no longer just reacting to inflation headlines. Silver is no longer just reacting to industrial demand. Miners are no longer just reacting to metal prices. This is becoming a confidence trade, a cost trade, a reserve trade, and a political trade all at the same time. That is why it feels messy. That is also why it matters, because in markets, survival usually beats prediction. The people who last are rarely the loudest. They're the ones who size positions, respect pullbacks, and understand that conviction without liquidity can become a problem very fast too. If you found value in this breakdown, subscribe, stay close, and comment "John AG" so I know you're still watching these longer deep dives. We are going to keep tracking the data, not the panic. And as always, this is for education and market discussion only. I'm not telling you what to buy, sell, or hold. Do your own work, understand your own risk, and never let one video make a financial decision for you.